So on August 19th, Wall Street was, they were expecting a pretty modest 3-cent profit from Webull,
Right.
but instead they got 12 cents. I mean, that is a 300% beat. It just completely broke every forecast model out there.
Oh, absolutely shattered them.
Yeah, so welcome to Market Pulse Daily. Let's get right into this deep dive. Our mission today is to really unpack this massive earnings shocker from the retail brokerage space. We're going to dig through this towering stack of August 2026 equity research, the financial filings, and market data to figure out what changed. Like, is this explosion in their numbers just a flash in the pan, or are we witnessing a totally fundamental transformation of their business?
And it really is the kind of quarter that just forces you to, throw out all your old assumptions.
Yeah.
Because when a company beats estimates by that kind of magnitude, it usually means the street just fundamentally misunderstood the underlying business mechanics.
Yeah, completely. Before we really get into the weeds, though, just a quick reminder for you listening, we've got a link to the StockOracle 14-day trial in the description below. Just a heads up, this is an affiliate link, so we do get a commission if you sign up. Also, keep in mind that any AI insights or value estimates we discuss might be wrong, the data can be delayed, and, as always, none of this is financial advice or a buy, hold, or sell rating.
Exactly, just pure analysis of the research.
Right. So let's jump straight into the wreckage of those estimates. Q2 2026, Webull reports $198.8 million in revenue. That's up 51% year over year.
Which is huge on its own.
It is, but the bottom line is what really stops you in your tracks. Like we said, adjusted earnings per share hit 12 cents versus the 3 cents that, the analysts who do this for a living actually predicted.
Yeah, and if we want to get really precise with the numbers here, that translates to a GAAP profit of $24.4 million for the quarter.
Okay, wait, let me pause you right there just to make sure everyone listening is on the same page. When we say GAAP profit, generally accepted accounting principles, that's like the strictest possible measure of profitability, right?
Yeah, it includes all the messy stuff.
Right. But the research also points out their adjusted operating profit hit $62.6 million. I mean, that's a massive gap between $24 million and $62 million. What is the actual takeaway there? Which numbers should we care about?
Well, it's a really crucial distinction, right? So GAAP includes every single cost. And most notably for companies like this, it includes stock-based compensation.
Oh, right. Paying employees in shares.
Exactly. Fast-growing tech platforms, brokerages, they pay their top engineers and execs in stock. So that's an expense on paper, sure, but it doesn't actually drain cash from the company's bank account.
Got it.
So that adjusted figure, the $62.6 million, it strips that paper expense away. It shows you the actual cash-generating power of the core business right now. And I mean, both numbers are heavily in the green, which is just a wild contrast to where they were recently.
Unbelievably stark. I mean, for context, look at the full year of 2024. Webull was just bleeding cash. They posted a net loss of almost $23 million.
Right.
Then they finally swing to a profit of about $24.7 million for all of 2025. And now, in a single quarter, just Q2 of 2026, they essentially matched their entire net income from the previous year.
Yeah, in 3 months.
And they did it with a gross margin sitting at like a staggering 76.55%. I mean, looking at this, it feels like a startup that finally stopped burning cash and just suddenly figured out how to print it. But honestly, is a 76% gross margin even normal for a trading platform?
I mean, no, it's exceptional. But it perfectly illustrates this financial concept called operating leverage.
Okay, break that down for us.
So think about a traditional business, like an airline. If an airline wants to fly 50% more passengers, they have to go out and buy 50% more planes.
And hire more pilots, buy more fuel.
Exactly. Their costs rise almost identically with their revenue. But Webull's business model is completely different. It is incredibly asset light.
Because it's all software. They aren't, building physical bank branches on every corner.
Precisely. In all of 2025, their capital expenditures, meaning the money they spent on actual physical infrastructure, was only about $4.9 million.
Wow. That's nothing for a company that size.
Right. So once their core digital platform is built and the fixed costs, the servers and the base salaries are covered, almost every single extra dollar of revenue they bring in just falls straight through the floorboards to the bottom line. It's pure profit.
Okay. So a 51% increase in revenue doesn't mean a 51% increase in expenses. The costs stay pretty flat, and the profit margin just balloons.
Exactly.
That makes total sense on paper. But you don't just, wake up one morning and find a 51% revenue increase hiding in the couch cushions. There had to be some sort of major structural change to their actual business to drive that kind of money through the door.
There absolutely was. And looking at the catalyst stack here, our sources point to two massive structural changes. And the first one involves this major shift in the regulatory landscape. It just completely changed how users behave on the app.
Okay, you're talking about the PDT rule, right? The pattern day trader rule removal.
Yes.
So for anyone who hasn't spent a bunch of time day trading, let's just explain how brutal this rule used to be. Historically, if you executed 4 or more day trades within 5 business days, the government stepped in and mandated that you maintain a minimum account balance of $25,000.
Which is a huge barrier.
Massive. It basically kept everyday retail traders totally locked out of active high-frequency trading.
Right. It was this artificial speed bump. I mean, it was designed to protect smaller investors from blowing up their accounts. But in practice, it severely choked off platform engagement.
Yeah.
So with the removal of that rule, that $25,000 barrier just vanished. Now, Webull's users, even the ones with just a couple $100 in their account, can day trade as frequently as they want.
So for Webull, taking that rule away is basically like, I don't know, taking the speed limit off a highway. Suddenly everyone is just flying. And for a brokerage, higher trading volume means more transaction revenue, more payment for order flow.
Exactly. It's a volume game.
But I do have to play devil's advocate for a second here, because if they are this heavily reliant on people actively day trading every single day, aren't they incredibly vulnerable? Like, what happens when the market cools off or the crypto hype dies down and people just stop tapping the buy button?
And you've hit on the exact vulnerability that has historically plagued these kinds of platforms. It's the boom and bust cycle. And that brings us directly to the second structural change, which honestly is arguably the most critical piece of this whole financial puzzle.
Okay, lay it on us.
Webull's leadership clearly saw that exact vulnerability. They knew they couldn't just rely on transaction volume, so they aggressively expanded their margin loan balances.
Okay, margin loans, let's make sure that's clear. This is when users actually borrow money directly from Webull so they can buy more stock than they could afford with just their own cash, right?
Yes, exactly. And when Webull loans out that capital, they charge a fairly significant interest rate on it. This generates what we call net interest income.
Okay.
And it completely shifts the quality of their revenue. They're transitioning away from purely unpredictable transactional volume. You know, the stuff that spikes and crashes based on whatever meme stock is trending to a much more stable, recurring base of interest income.
It's kind of like a casino, right? Like relying on people to play the slot machines is super unpredictable. So they decide, hey, let's also become the bank that loans people the money to stay in the hotel.
That's a great way to look at it.
Right. Because the interest on the loan gets paid back to the house regardless of whether the player wins or loses at the actual slots. It acts as a huge shock absorber against market downturns.
A very, very lucrative shock absorber. When you combine that stable interest income with the extreme operating leverage we were just talking about, you create this financial engine that can really weather a lot of storms.
But Webull isn't just stopping at margin loans. And this is where the research gets deeply, deeply fascinating to me. They are actively trying to ensure that their revenue doesn't just stabilize, but actually compound.
So they're aggressively expanding the ecosystem.
Yeah, they're rolling out entirely new product verticals. We're talking futures trading, prediction markets, and they've even partnered with monarch markets to give everyday users access to private companies.
Which is usually reserved for the ultra-wealthy.
Exactly. That alone is a massive expansion. But the thing that really jumped out at me from this August 2026 data is their technical evolution. They just launched native AI connectors for ChatGPT, Claude, and Grok. And they did it through a command line interface, a CLI.
Yeah, and this specific move tells you exactly who Webull is trying to attract now. And it is not the casual trader checking their phone on a lunch break.
Well, yeah, let's explain what a command line interface actually is, because it sounds incredibly intimidating for the average person.
It is.
A CLI means there are no buttons, right? There are no colorful charts, no swiping, no graphical interface at all. It's literally just a black screen with text where you type in raw code. It's like bypassing the steering wheel and the dashboard of your car and just plugging a laptop directly into the engine block to drive.
That's a perfect analogy.
So why on earth would a retail trading app spend resources building something like that?
Because they want the machines to do the trading. By integrating those native AI connectors directly into a command line interface, Webull is building a highly specialized toolkit designed specifically for developers, quantitative analysts, and algorithm traders.
The power users, like the actual robots.
Exactly, the robots.
Right.
These algos, they run scripts that can analyze market conditions and execute, hundreds of trades in the time it takes a human to blink. An algorithm doesn't need to sleep, doesn't hesitate. and it generates vastly more transaction volume than any human trader ever could.
Yeah. Right. So Webull is intentionally building this technological moat around this super lucrative demographic, and that drives up their average revenue per user exponentially.
Precisely.
So they're keeping the shiny, easy-to-use app for the masses to secure that base, but simultaneously building this high-speed backdoor for the robots to come in and just trade at light speed. And speaking of trading around the clock, we absolutely have to talk about the massive industry tailwind mentioned here regarding NASDAQ.
Yes, the 23-hour trading day. This is a total paradigm shift for the global financial system.
Yeah, so NASDAQ is preparing to extend trading to 23 hours a day, 5 days a week. They are essentially eliminating the whole concept of the opening and closing bell so they can capture global demand.
Which is just wild when you think about legacy systems.
It is, and let's connect the dots here. If you're Webull and you've just unleashed your retail users by removing the PDT rule, and you've just invited all these AI algorithmic bots to your platform via command lines, a 23-hour trading day is basically like someone telling you that you can keep your casino open all night long.
Exactly.
Yeah.
Because traditional legacy brokerages, they just aren't built for that kind of continuous 204/7 engagement. I mean, their infrastructure, their customer service models, they all assume the market sleeps.
Right.
But an app-based, AI-integrated platform like Webull, it thrives in an always-on environment. They stand to disproportionately benefit from an extended trading day compared to the old guard.
All right, so let's summarize the reality of the business so far based on these confirmed developments. The margins are incredibly healthy. The structural growth drivers, the PDT rule removal, and the margin loans are firing on all cylinders. The tech moat is being built for the quants, and the NASDAQ tailwinds are massive.
So the business is demonstrably stronger.
Yes, structurally. But now we have to look at the market interpretation. How is Wall Street actually pricing this reality? And looking at the market reaction and the technical charts, there is just this bizarre disconnect.
It really is a fascinating psychological study of how markets behave, honestly.
Let's look at the actual numbers. Following that August 19 earnings beat, Webull closed at $8.64. Now, from a technical perspective, there is a massive tug of war happening. Over the last 6 months, the stock has recovered 47%.
Which sounds great.
It does. But even at $8.64, it is still trading 47% below its 52-week high of $16.32. And its price-to-sales ratio is sitting at 6.89.
Right. And to put that 6.89 price-to-sales ratio into context for you listening, a rapidly growing tech platform boasting 51% revenue growth and 76% gross margins, they would typically command a multiple of 15, 20, maybe even higher.
Yeah.
So a multiple of 6.89 suggests the market is treating them like a mature, slow-growth legacy company, not some hyper-growth disruptor.
That is just wild to me. A company can post blowout numbers, swing entirely from a multi-million-dollar loss to massive profitability, rally 47% in half a year, and still be viewed with this much suspicion. I mean, they are trading at half their yearly high. And the relative strength index, the RSI, which measures short-term buying momentum, it's over 75.
Right, which signals it's overbought in the short term.
Exactly. It means retail traders are frantically buying into the good news right now. But institutional money is clearly just sitting on its hands. Why aren't the big funds flooding into this?
Well, what you're seeing on that chart is essentially financial trauma.
Trauma.
Yeah. Think about it. The stock fell 42% over the last year before this recent recovery began. Institutional money remembers that kind of pain.
They don't forget quickly.
Exactly. So the frantic short-term buying you see in the RSI, it's clashing directly with this deep, lingering historical skepticism from the institutional investors who got burned during the last downturn. They are looking at these phenomenal Q2 numbers and asking themselves, is this a permanent transformation? Or is this just a lucky quarter fueled by a temporary spike in market volatility?
Which naturally forces us to look at the bear case. We have to address that historical doubt head on. Because if the numbers are this good right now, what is the smart money actually afraid of? What could derail this? The research highlights 3 main existential risks. So let's explore the first one, cyclicality.
This is the elephant in the room that we alluded to earlier with your devil's advocate point.
Yeah.
It's the fear that retail trading is fundamentally just a cyclical fad.
Right. So let's run a thought experiment for you. Imagine if the broader market just goes completely flat for the next 6 months. No wild crypto swings, no massive tech rallies, no meme stock explosions, just sideways, boring action. What happens to all those new day traders Webull just acquired when the PDT rule was removed?
They get bored, and they leave. This is what institutional investors call a thesis breaker. If the market flatlines, retail engagement historically plummets. People stop checking their apps, they stop day trading.
And if that happens, transaction revenue falls off a cliff.
Exactly. And it will expose the fact that Q2 wasn't a permanent structural inflection, but just a cyclical peak.
And even though we talked about margin loans acting as a buffer, the reality is if people aren't trading, they aren't borrowing money from Webull to trade either. Those two revenue streams are still linked.
Right. If the trading stops, the borrowing stops, and the entire growth narrative just unravels.
Okay. The second major risk highlighted in the research is regulatory scrutiny over data security and international ties. The filings note quite prominently that Webull is a foreign private issuer.
Yes, and this is crucial context. Webull's parent company has significant ties to China. And in the highly sensitive financial sector, where a platform holds personal data, social security numbers, banking info for millions of U.S. citizens, that international tie represents a massive looming vulnerability.
It is the ultimate headline risk. It has absolutely nothing to do with how good their margins are today. If a U.S. regulatory body suddenly decides, hey, we are uncomfortable with this corporate structure holding domestic financial data, and they impose strict compliance costs or restrict operations, the business can evaporate overnight.
Instantly. All the operating leverage in the world won't save you from a regulatory hammer.
Wow, yeah.
It is a wild card that operates entirely outside the boundaries of market fundamentals. And it's a primary reason why institutional investors demand a massive discount on the stock.
Which leads directly to the third risk, valuation compression. This is just brutal math.
It is. Right now, at that $8.64 price point, the market is just starting to price in the expectation of sustained high growth. But if their revenue growth decelerates, say it drops from 51% down to below 30%, the market will abruptly re-rate the stock.
Downward.
Sharply downward. The valuation multiple will compress, and the stock could easily slide all the way back down toward its 52-week low of $4.50. In hypergrowth tech valuations, the margin for error is razor thin. If you miss a step, the punishment is severe.
Man. Okay, so let's talk about the blue sky scenario because, we have to look at both sides. And I want to clearly state right now, this is an optimistic scenario based on the catalysts lining up. This is not a prediction. But if things go right.
If all these catalysts stack up perfectly.
Yeah, if the structural shifts from the PDT rule removal permanently elevate trading volumes and margin lending keeps compounding, and these new AI command line tools actually capture the algorithmic market just as NASDAQ opens up a 23-hour trading day, you're looking at a massive fundamental re-rating of the stock. It becomes a profitability engine built for the future.
But pulling hard in the exact opposite direction, you have the very real threats of market cyclicality, valuation compression, and unpredictable regulatory risks. It's a tug of war.
It really is. So, for you listening, how do you make sense of this? What should you watch next?
We've got three main things. First, the next big event is their Q3 2026 earnings. Don't just watch the stock price ticker. Look past the headline revenue number.
Yes, look at the underlying metrics.
Exactly. You need your confirmation signal. Dig into the filings and look specifically to see if margin loan growth is continuing to compound. Also, look for actual adoption metrics of their new product verticals. Are people actually trading futures? And are the quants actually using those AI connectors?
Right, because if those metrics are growing, it proves this momentum is durable.
And the main risk signal, if you see a sharp drop in transaction volume or margin balances, it proves Q2 might have just been a summer fling with a volatile market.
The Q3 data won't just be an earnings report. It will be the ultimate lie detector test for Webull's structural transformation. It's going to be a fascinating quarter to watch unfold, no doubt. Just a quick reminder before we wrap up, be sure to check out the description for that StockOracle 14-day trial link. Again, it's an affiliate link. Remember that AI insights and value estimates can be wrong, and the data may be delayed.
Standard disclosure is always important.
Yeah. But I do want to leave you with a final lingering question to ponder on your own, building on everything we've explored today. If retail trading platforms are rapidly evolving into these 23-hour AI-driven multi-asset ecosystems where algorithms execute trades via command lines at 3 in the morning, what does that actually mean for the future of traditional investing?
It's a wild thought.
Are we witnessing the permanent gamification and acceleration of the stock market where sleep is literally the only remaining barrier to trade? And if the predictable weather map of traditional finance is permanently broken by these 2,047 algos, how do you plan to navigate the storm?
A storm that, quite literally, never sleeps. Thanks for joining us on Market Pulse Daily for this deep dive. We'll catch you next time.